How's it going, everybody? Michael and Coco here to do some technical analysis on the financial markets. We're going to be looking at the S&P 500 today. We're going to be looking at the NASDAQ 100, the Dow Jones, Russell 2000, the dollar index. We're going to be looking at gold and silver as well. Now today, clearly a big down day in the markets, and we have been talking about how overextended this rally has been. So it's quite normal to see aggressive moves to the downside such as this. We're going to be looking for areas of support and trying to see how we can navigate this ourselves. Now, it's very important as retail investors to watch things like this because it's going to help us prepare for future moves. We have been living in unprecedented times. We have the Federal Reserve going into quantitative easing 4, which is bigger than 1, 2, and 3 all combined. Pretty much it's QE unlimited. We've had the stock market ramping up, creating extreme new records, and it's all been really driven by this massive tech rally, the FANG man stocks, these 7 group of stocks. Now, what I want to point out that I find very interesting about the market capitalization of these stocks, I'm going to use Apple and Tesla for an example. This right here is Apple's market cap. As you can see, September 3rd, it's worth $2.076 trillion. That is still just a gigantic market cap, and you can see the pullback just as of recently. But if you look at this, from September 2nd to September 3rd, it goes from $2.247 trillion to $2.076 trillion. Now, you might just be saying that's nothing, but let me put that into perspective of how big that actually is comparatively to other companies. Here is ExxonMobil. Have you heard of ExxonMobil? Well, it's a gigantic company. And as you can see, their market cap as of September 3rd is $165.11 billion. That means that in one day, Apple lost a market cap of the entire Exxon company. Just to put it into perspective, you got to hear that. In one single day, the market cap of Apple wiped out an entire ExxonMobil's market cap. Crazy. This right here is Tesla's market cap as of September 1st, $442.7 billion. And today I pulled up the chart and they dropped $64.9 billion in market cap. That alone is the market cap of Ferrari, BMW, Honda, General Motors. Are you understanding the point here that this right here is extreme bubble territory? And the market cap insanity doesn't really stop there. We have Zoom, which is a software company, surpassing $100 billion in market cap as well. Absolutely incredible stuff in the tech sector. This is a bubble at its finest. No way in heck are these companies worth what they're being valued at. They're clearly trading way over their earnings. So this is a perceived type of value. Now, what's interesting and what you got to make sure you kind of understand within this, as we're seeing this blow off top that we've been kind of talking about take place, you need to understand that professional investors, okay, not retail investors, I'm a retail investor, but professional investors, institutional investors are using derivatives, leverage, to chase into this momentum. And that, by doing that, when there is downside risk, it's going to eliminate some of those tailwinds that they'll incur in the future. So they run up the market and they're buying things highly leveraged derivatives, and that's totally fine. They're professional institutions. They know what they're doing. However, when you have retail investors also jumping in ship and using highly leveraged options, and we'll bring up the call to put options ratio here in a moment. And the chart that I showed yesterday showed that 12% of the volume of the New York Stock Exchange is coming from options. So when retail investors start hopping into derivatives, what happens is they don't quite know how to navigate that as well as professional institutions. When the professional institutions start unloading those, or they stop purchasing these call options or derivatives, you will see pullbacks in the market take place. Now, we've been talking about all these overextended moves, etc., and this is typical to see. This doesn't mean that the market's collapsing right now, which we'll be getting into here in the near future, but what I want to point out is retail investors are the ones that are going to get hurt the most during these type of price action moves. And that's why you're here. That's why you watch this kind of stuff, is because we need to plan ahead of time and be prepared for these type of moves, because sometimes when they get away from you, especially in the overnight sessions, it's very hard to come back from. Let's go ahead and hop into the S&P 500 portion of this market brief. Now, the S&P 500 closed today at 3,455. That was down 3.51%. Pretty darn big down day, wiping out really 1, 2, 3, 4, 5, 6 trading days. Now, when we were looking at the S&P 500 yesterday on the weekly time frame, let me bring it up, I was explaining that, hey, you know what we might see is the potential of a wolf candle or a reversal type candle where it opens up, kind of comes way up higher, and that's what happened. And then yesterday we're like, but I don't know if it can really get down there. Well, surprise, surprise, what do we have going on right now? A gigantic reversal type candle. So could this potentially be the market top, or is this just kind of pulling back to find some more momentum to the upside? That's still an extreme possibility. Now, this is the daily time frame of the S&P 500. We were very overextended to the upside, overbought on this oscillator, that relative strength index, and we had this big snapback down to 57.31. So we're back within that realm. Let's go ahead and look at the Bollinger Bands right now. And as you can see, we were really getting extended from the Bollinger Bands right here as well. And then the snapback really stopped right here at this middle portion of the Bollinger Bands. And that is the 20-period moving average. So no shock to see that happen. These things happen, especially when the price action gets so far overextended. I personally think that we should still be seeing more of a pullback. And more of my target area, I've been saying, was 3,000 to 3,200. However, I'm still preparing for a pullback to 3,400 to go long from there, but I'm going to have a tight stop loss just in case that this momentum tries to continue to the downside. I'm going to get rid of the Bollinger Bands really quick here because they just kind of bug me looking at them. So what else do we got going on? So first off, the 3,400 is that level of support that I'm looking at for a potential buy the dip. And right now, you need to be careful with the buy the dip mentality, okay? With a day like this, and I'll point this out, okay? Actually, a tweet that Jim Bianco did, I'll bring up here in a moment, but really, we haven't seen this type of downwards action, these type of big down days since right here, and that was June 11th. And then also right here, I think is it April 1st? Yeah, April 1st was another big gap down day. So April 1st, and then also June 11th, those were really the biggest percentage point down days that we've had since the March bottom. But what you need to look at with those dates, and Jim Bianco, let me just pull up that tweet now. Now, if you don't follow Jim Bianco, you can follow him on Twitter at Bianco Research. He is an analyst. What he noticed and he pointed out was that those two larger declines, April 1st and June 11th, they didn't see any momentum carry on to the downside. So they were just a one-off strong down day. Now, what we were talking about as far as the institutional investors go and getting out of the derivative market or pulling profits, and then you see these large down days, if the downwards momentum continues, the buy the dip does not quite work nearly as well because the retail investors are going to be getting trapped within those positions as the professional institutions pull more money from those or move into short positions. So what we need to watch out for going into tomorrow is to see if we have follow through continue. Now, the first two big down days, the April 1st and June 11th, they did not have follow through. As you can see right here, this gap down and then it trailed sideways and moved higher. June 11th, right here, huge gap down, strong momentum to the downside, went sideways. This was what we called the loading gun pattern a while ago. And then really we saw a little bit more to the pullback to the 3,000, the beautiful trade that I missed, and then it ran up on me all the way up to here. Now we are seeing another big down day. So are we going to see a continuation to the downside, which would indicate, hey, the buy the dip might be changing, or is this 3,400 potentially going to be the area where that dip comes into play and then we see more of a continuation to the upside? I don't have a crystal ball, or am I smart enough to know what exactly is going to happen. I will say, when things are super overextended and everything was telling us, hey, don't turn your back to a bear, it's likely that these things happen. You don't need to be a genius to see that, and I'm not a genius in the slightest. But we have been seeing this really strong momentum to the downside coming down to 3,400. I am getting ready to buy into the dip to go long, but I will be monitoring a very close eye on my stops. If we get continuation to the downside, more past 3,400, my target area is the bottom portion of the Bollinger Bands and the 50 period moving average, because the 50 period has clearly had a history of holding as support and acting as resistance. Keep an eye on the 50 and this 3,400 to begin, and then we'll follow through with more information on the S&P 500 in later videos. All right, so here is the CPCE, and really what this chart is telling me is we're still at historic lows on this specific index, meaning that really the entire market right now is long. They want to go long. They believe the stock market's going to go higher, and that right there could very, very well be just a cause for concern. So we are seeing this subtle crack in the markets right now, and will we see momentum carry and push forward more to the downside? It's possible, but really the market, at least on this index here, is still very bullish. This right here is the VIX, the Volatility Index of the S&P 500, and there was some cause for concerns these past couple of days. Yes, it broke out of the falling wedge, and we have a target between 40 to 45, I believe it was, and volatility really came up today, up 26.46% on the VIX. Huge day. Not surprised really at seeing this with the breakout of a falling wedge. The only thing that I was in my head was this gap is probably going to get filled, and I still think that it has the possibility of doing that, which leaves in my head the possibility of the market continuing to just maybe pull back but then go and make another high. So we're going to be monitoring this one, but really what was in my mind was typically you see an inverse correlation between the two, okay? When the VIX goes up, you have the S&P go down. But for a couple of days there, we were seeing the VIX decoupled from the index, and we saw the VIX go up as well with stock prices. And that right there was a little shaky ground, which we had mentioned in previous videos. And not long after today, we really saw that breakout in the VIX, and clearly the S&P 500 took quite a nosedive. Not just the S&P 500, the other indexes as well that we're going to get into. So let's actually do that. Let's hop over to the NASDAQ 100. So this right here is a chart of the NASDAQ Composite Index. I just did this a little bit differently. There's actually technically three charts. We have the NASDAQ Composite right here on the daily. We have the NASDAQ McClellan Oscillator, and then we have the Summation Index. And right here on the right side are just more zoomed in. And the reason why I'm showing you this is just to give you a good sense as to what kind of took place today. And we'll hop over to TradingView and kind of do a little bit more detailed analysis. But the oscillator has had a negative breath. We've known this, okay? The Summation Index as well has been heading down while the market has been going up. There's just been a lot of divergences, negative divergences within the market. So this type of action results in these type of moves. So we had huge moves in the NASDAQ, and this last candle on yesterday's video, this right here, this is a hanging man type candle, and really it's somewhat of a reversal type candlestick when you get that in an upwards direction. Let's go to TradingView to kind of map this one out a little bit better. All right, so here is the NASDAQ 100 on the daily time frame. We mapped out yesterday that it's been trading within this channel. We brought out the extension Fibonacci tool and kind of mapped out that 3,000 or 13,000 range, that if it were to get up there, be very hesitant to basically buy any long positions, because that would be extreme overextension. And really today we saw a 5.23% move to the downside, wiping out, really led by the tech sector. So big fallback coming into the bottom portion of this channel. So you got to ask, are we just going to see a bounce from this channel and continue to move higher? We're going to have to monitor that day by day. When I pull up the Fibonacci retracement tool, the level to watch out for is 11,109. Clearly it acted as resistance previously when it broke above, kind of backed us a little bit. And then we got that really big blow off right here to 12,448. So maybe we might be pulling back to this trend line. We might come a little bit lower. Gonna have to monitor this. This is the NASDAQ 100 on the monthly time frame, and we discussed this yesterday being extended outside of the Bollinger Bands, and it's still disconnected from the Bollinger Bands. We have a lot of time left in this month, so this could very well easily retrace into this a little bit deeper. Extended moves like this typically result in pullbacks, and this right here, even on the monthly time frame, you got to understand that an extension from the 50 period, not even the 200, but the 50 period, it's overextended by 64%. So the price of the NASDAQ 100 is extended 64% above the 50 period simple moving average. Still extreme overextension. I would not be surprised to see continuation to the downside or eventually some sort of reconnect. This right here is the NASDAQ Bank Index. And as you can see, not even clearly recovering from the February highs there in 2020. Unlike the NASDAQ 100, that's really being the market's being led by just a few big stocks that are carrying it higher and higher. And the NASDAQ Bank Index, which is comprised of 24 of the largest U.S. banks, which, Bank of America, Citigroup, they're within this index, clearly is just struggling to make anywhere close to new highs. Still, the price action remains below the 200 period. The 50 period, the price is above that, but it's still in bearish context. What you want to keep an eye on for is this kind of trend line. Clearly, it's getting rejected a few times, but we're putting in higher lows. So we very well may see the banking sector start to pick up some momentum to the upside. Could be potentially an opportunity, perhaps, but if we see a break below this, I'd say just kind of watch out and be very careful investing into these type of banks. I will say that there was recent news about Warren Buffett removing a lot of his portfolio outside of a lot of banks. I think he added to his position of Bank of America, but he did dump things like Goldman Sachs. And don't quote me on all of that of what he exactly dumped, but I think it was JP Morgan Chase and then Goldman Sachs, and there's probably some other ones in there that I'm missing. Let's go ahead and hop over to the Dow Jones. So here is the Dow Jones Industrial Average on the daily time frame. Today it closed down 2.78%. It's pretty aggressive drop to the downside, just like we're seeing in the other indexes. As far as a pullback area or level to potentially buy into on this sort of a dip, I'd be looking at really this 50 period moving average. Clearly it was overextended quite a bit from there, but the 50 period is sitting right here where this price pulled down to and then acted as resistance. And then we had the island reversal pattern right there. And then we had resistance right here as well. So 50 period sloping up. Then we have basically 27,000 acting as a pretty strong level of support as well. So if you are still of the buy the dip, sell the rip type of mentality, that could be very well a good area to get back into the long position if we get a pullback and maybe a move like that. Now, if we start seeing breaks below that, what could be potentially taking place is the breakdown of a rising wedge pattern. If we go like this right here, we see some multiple connections from here, and then from this point to the island reversal pattern, we clearly have a rising wedge. It's coiling tighter and tighter. So keep an eye out for that type of pattern to be breaking down. That could very well be a sign. I'm of the belief that this market's going to be still heading higher. But if we do see some follow-through days, then I might just pull away from the idea of buying the dip and selling the rip. Let's now go ahead over to the Russell 2000. So this is the IWM. This is the iShares Trust Russell 2000 ETF. And you can go to the RUT, the RUT2 as well, but I'm just going to look at this. And what we mapped out yesterday was this bull flag where it popped up, very similar to the Dow Jones, and boom, boom, and then we started seeing the breakout. But clearly today it's down 2.95%. Not as bad as the other indexes, which is kind of nice to see. As far as where this can continue to the downside, this 50 period and 200 period right here will probably act as a level of support. And the reason why, it's clearly acted as resistance and support in that past, so I don't see why it wouldn't hold up around there as well. If we do start to get a break above 160, this heavy resistance right there, when you look back in the charts, it acted as support right here. But if we get a break above that, the next level to keep an eye on is that 166 to close that gap right there. If we get above that, we can send the small caps a lot higher. This right here is the dollar, the DXY. We've been kind of tracking this little channel that it's been within, and we saw this bounce pop up to this upper part of the trend line. And really what I wanted to call out here is this daily candle that formed. So this was looking pretty bullish up until this previous candle. Now this could just be a little slight hiccup. Really what I wanted to show you is was a hammer candle right here, and it was on a down move, and then we got the bounce. When we got this candle, this is a reversal type candle at an area that's clearly acting as a level of resistance. So this might very well just be a temporary bounce, and we're going to see some movement like this still to continue. However, if we do get the break above this channel, we might see more upwards momentum to the upside. Why else would I be thinking this? Well, let me show you the weekly time frame of the DXY. So here is the weekly chart, but what I wanted to point out is the RSI never moved into oversold territory. We're starting to see a little bit of a bounce from that point and recover. Now, this doesn't mean that it can't get into oversold territory and continue to push lower. Most really big drops and fallouts happen when the RSI is already down here. So we're going to monitor this, but what I wanted to show you was the last time that this RSI indicator was actually oversold was quite some time ago. You have to go back to 2018 to see the last time it was oversold. So 2 years ago, the DXY was in oversold territory. And then right here, it's not quite at that level. So are we potentially seeing the start of basically the dollar basing out to potentially make a move more to the upside? With everything that the Federal Reserve is doing, printing more dollars, unlimited QE, more and more debt, I personally am on the side that the dollar will be breaking down. However, there's plenty of theories out there. Well-educated people are saying that there's going to be a big spike in the near future of the dollar index, where we're going to see heavy demand for the dollar. And if that's the case, we could see the dollar spike very fast and very high. If you want to learn more about those theories, one of the more popular ones is called the dollar milkshake theory, and that is developed by Brent Johnson. Here is the daily time frame on gold, and I am quite a gold bull. I think that we're moving into a bull market. I would like to be able to buy some more gold. However, I would personally like to have the price contract more and come more down to about 1800. So I'm a buyer at around 1800 to 1815. I would like to accumulate some more. Now, what we got going on right now is, as I stated, and actually in the previous gold technical analysis video, you can see that on my YouTube if you haven't, but really the price spiked up pretty sharply, and then we had that 50% retracement after this kind of blow off, which we kind of discussed and talked about, and then we're seeing some consolidation. But the consolidation that's taking place, note that it's creating lower highs. So we're seeing lower highs take place. So we have, the stair steps going downwards. We have this massive level of support right here. This was, I believe, the 50% retracement level, or maybe that was the previous market high. Let me see. Yes, that was just about the 50% retracement level from the breakout spot, and that is holding, and we have the 50 period sloping up to it. So this is kind of a descending triangle. Now that could be argued that it's a symmetrical triangle because you have this as well. So you have higher lows and lower highs. So this can very well just be a symmetrical triangle. But when I look at this level right here, if we start closing below it, that would make me think that the price of gold is going to be heading lower, and the stop area that I would say is the where it can come down to is that 1815, 1800 level. Still overall very bullish context in the price of gold. You had the 50 period sloping up, you had the 200 period sloping up, big spread between the two. From a technical perspective, gold looks very strong. It's just at this very interesting crossroads right now, and it's kind of deciding which way it wants to go. Me personally, like I said, I would like to see the price of gold retrace even more because that is very healthy in bull markets and it would allow for people to pick up some more if they want to. Let's go ahead over to silver. Here's silver on the daily time frame, very similar to gold. It's been getting beat up these last 3 days. Very well might lead to some type of bounce here in the near future. What we saw and what we pointed out in the previous video was we said it would be likely to see a 50% retracement. We got that, and then this level right here has been holding as a support. That right there is 20, basically let's call it $26. It acted as resistance, broke up, and then we had a retracement below it, very overextended move, and we said that, hey, it's likely to see an overextension, rubber band move to the top, and potentially reach up to this top portion, which it really just did. And the last time we saw these aggressive moves similar to this huge drop, 13% drop, was quite some time ago. And that's when we kind of measured it out and said, yeah, this looks like an overextension, rubber band, boom. But the current price action right now is trading very similarly to gold, not surprised. And it's creating these lower highs as well as these higher lows. So another symmetrical triangle pattern. Let's just make sure that we watch out for the breakdown of $26. If we get a close below 26, it's very likely to see it continue to move more around the $22 to $23 range for a next buying opportunity. My eye is on the 50 period moving average. If we get a breakdown below that, very well might bounce from there and then continuation to the upside. I am bullish on the price of silver. I do see silver being higher in the future. And what's very interesting is gold has broken records and made new all-time highs, whereas silver has still a lot of room to go to get close to making an all-time high. All right, everybody, that is all I have for you on today's market brief. Went a little bit longer than anticipated. Still trying to work out the kinks. If you guys have suggestions, leave them in the comment section below. I'll see you back tomorrow.